Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are cracking open the company that literally watches chips being born. KLA Corporation, ticker KLAC, the undisputed king of semiconductor process control.
Lana Chen here. And Hudson, this is a company trading within a whisper of its all-time high at $1,727 a share. It just held an investor day that had Wall Street buzzing, announced a $7 billion buyback, and hiked its dividend 21%. There is a lot to unpack.
A lot is an understatement, so let me set the stage. KLA is the quality inspector of the chip world. Every major fab on the planet, whether it is TSMC, Samsung, or Intel, uses KLA's tools to find defects at the nanometer scale. If a chip has a flaw, KLA's machines are the ones catching it before it becomes a very expensive mistake.
The company was founded in 1975 in Milpitas, California, right in the heart of Silicon Valley. It went public in 1980, merged with Tencor Instruments in 1997, and rebranded from KLA Tencor to just KLA Corporation in 2019. Rick Wallace has been at the helm as CEO and has guided the company through multiple semiconductor cycles.
And what KLA actually does day to day is fascinating. They operate across 4 segments. The big one is semiconductor process control, which is the bread and butter. Think wafer inspection systems, metrology tools, and reticle inspection equipment. Then you have specialty semiconductor process, covering etch and deposition for niche applications.
The third segment is PCB, display and component inspection, which handles printed circuit boards and flat panel displays. And then there is a smaller, catch-all other segment. But make no mistake, the Semiconductor Process Control Division is the engine that drives this company.
The important thing to understand is that KLA's tools are not optional. As chips shrink to 3 nanometer and 2 nanometer nodes, the margin for error completely disappears.
Exactly. A single particle of dust on a wafer can ruin an entire batch of chips. KLA holds over 50% market share in wafer inspection, and that share has been remarkably sticky because switching costs are enormous. Fabs build their entire quality workflow around KLA's systems.
15,000 employees keeping the chip world honest. That is a great business to be in. All right, Lana, let us get into the numbers because they are substantial. Walk us through what KLA looks like financially right now.
Starting with valuation, KLA trades at a trailing price-to-earnings ratio of 49.8 times. The forward PE drops to about 36.1 times based on next 12 months' earnings estimates. Price-to-book is 41.6 times, and the enterprise value to EBA multiple sits at 39.1 times.
So this is not a cheap stock by any stretch.
Not cheap, no. The forward PEG ratio is 1.6 times, which suggests the growth rate partially justifies the premium, but this is still a stock priced for continued execution. Now let me walk through the income picture.
Please do.
Trailing 12-month revenue is $12.7 billion, up 17.6% year over year. That revenue has been climbing quarter after quarter. Looking at the last 4 quarters in sequence, you had $3.06 billion, then $3.17 billion, then $3.21 billion, and the most recent at $3.3 billion. A nice upward staircase.
Consistent acceleration, no lumpy quarters.
Diluted EPS over the trailing 12 months is $34.37, with earnings growth running at roughly 29%. Now the margins, and this is where KLA really shines. Gross margin is 61.9%.
62% gross margin. That is software-like profitability from a company that builds physical machines.
It reflects the mission-critical nature of the product. Fabs cannot negotiate hard on inspection tools when the alternative is shipping defective chips. Operating margin is 42.4%, and net margin is 35.8%. For every dollar of revenue KLA collects, it keeps almost 36 cents as pure profit.
Elite numbers. What about cash flow?
Free cash flow over the trailing 12 months is $4.4 billion. The FCF yield is 1.9%, which looks thin on paper, but that is a function of the elevated stock price rather than weak cash generation. Quarter by quarter, free cash flow has been trending up nicely, $987 million, then $1.06 billion, then $1.07 billion, and the most recent quarter came in at $1.26 billion.
So the cash machine is actually accelerating, each quarter bigger than the last.
It is. On the balance sheet, total debt is $6.3 billion, and net debt is $3.8 billion. Debt to equity is 1.15 times, which is manageable. The more important metric is debt to EBITDA at just 1.06 times, meaning the company could theoretically pay off all its debt with about 1 year of EBITDA.
That is very comfortable leverage.
The current ratio is 2.77, so there is plenty of liquidity to handle short-term obligations. Total assets sit at $16.7 billion. Now let me cover dividends because this just got a major upgrade.
Yes, the Investor Day bombshell.
KLA currently yields 0.44%, which sounds modest, but the company just announced a 21% increase to its quarterly payout, bringing it to $2.30 per share. That translates to a new annualized rate of $9.20 per share.
And this is not a one-time thing. This is the 17th consecutive year of dividend increases.
Correct. The payout ratio is only 21.6%, so there is enormous room to keep growing it. The 5-year dividend compound annual growth rate is roughly 15%. You are not buying KLA for the current yield. You are buying it for the trajectory.
A 15% dividend growth rate with a 22% payout ratio. That flywheel can spin for a long time.
Overall, KLA's financial health is strong. Elite margins, accelerating free cash flow, conservative leverage, and a growing capital return program all point to a company in excellent financial shape.
All right, let us talk about what the street thinks. The analyst consensus on KLA is a buy, with about 20 analysts covering the stock. The average price target sits at roughly $679, which is actually slightly below where the stock trades today at $1,727.
That is an important detail. When the stock is above the average target, it means the market has gotten ahead of analyst expectations.
But some of the more bullish analysts have caught up. Cantor Fitzgerald raised its target to $2,000 after the Investor Day in March. Oppenheimer went to $1,900.
And on the upgrade front, TD Cowen moved from hold to buy in January. Wells Fargo upgraded from equal weight to overweight that same month. Jefferies went from hold to buy back in December. So we have seen a clear wave of upgrades over the past few months.
What about insider activity?
12 insider sales in the past 6 months, totaling roughly $30 million. CEO Rick Wallace sold approximately 21,600 shares for around $22.9 million. All of these appear to be planned dispositions tied to equity compensation. There were 0 insider purchases during the period.
No one on the inside buying, but the selling looks routine. Not a red flag in my book. Now, the most recent earnings, Q2 fiscal year 2026, reported January 30th. Revenue came in at $3.3 billion, beating the estimate of $3.28 billion. Non-GAAP EPS was $8.85 versus the estimate of $8.81. Modest beats on both lines.
Year over year, that was 17% revenue growth and 29% earnings growth for the quarter. The company also reported record free cash flow for the period. Management guided Q3 at $3.35 billion in revenue plus or minus $150 million, with non-GAAP EPS of $9.08 plus or minus 78 cents.
And then at the March Investor Day, they raised the full-year outlook and projected high teens revenue growth for all of fiscal 2026. Confidence from the top.
They also laid out ambitious 2030 targets, which we will get to.
All right, time for the bull and bear case. Let me lay out why the bulls are excited about KLA. First and foremost, the AI infrastructure build-out. Every new AI chip needs to be inspected. As chips push to smaller nodes, the complexity of inspection goes up exponentially, and KLA is the go-to provider.
The volume of transistors on a single wafer at 2-nanometer nodes is staggering. More transistors means more potential defect sites, which means more inspection passes are required. It is a structural tailwind.
Second, the memory ramp. HBM3, HBM4, and DDR7 are all requiring increasingly precise inspection and metrology. High-bandwidth memory stacks multiple dies on top of each other, and any defect in any layer ruins the entire stack.
Third, the services business. Management is targeting 13 to 15% compound annual growth in service revenue, with the goal of doubling it to nearly $6 billion by 2030. Over 80% of that would come from multi-year contracts.
That is a sticky, recurring revenue stream that smooths out the cyclicality of equipment sales. If they hit that target, Services alone would be a massive business.
Fourth, advanced packaging. As the industry moves toward chiplet architectures and heterogeneous integration, entirely new inspection workflows are needed. KLA is positioning itself to capture that emerging demand.
And fifth, the global fab build-out. CHIPS Act subsidies in the United States, European investments, Japanese expansion. Everyone wants domestic chip capacity now. Every new fab being built around the world is a potential KLA customer.
Now for the bear case, and there are real risks here. First, China. KLA's revenue from China has dropped from 41% to 30% of total sales as export controls have tightened. That is a deliberate de-risking move, but it means KLA is voluntarily walking away from a significant demand pool.
And some of their competitors may still be selling into that market, at least for now.
Second, the valuation. Nearly 50 times trailing earnings is a lot to pay. If growth disappoints even modestly, there is not much cushion in the stock price. The stock is trading above the average analyst price target, which suggests the easy gains may have been captured.
Third, competitive dynamics. Lam Research is currently growing revenue at 22% year over year, compared to KLA's 7% on a recent quarterly basis. The market is starting to view Lam as a stronger pure-play AI beneficiary.
Fourth, Taiwan concentration risk. 60% of global semiconductor production happens in Taiwan. Any disruption to that supply chain, whether geopolitical or natural disaster, would ripple through KLA's entire customer base.
And fifth, cycle risk. The semiconductor equipment market is projected to grow high single digits in 2026 and 2027, but if the AI infrastructure build-out moderates, equipment spending could decelerate faster than anyone expects.
The WFE market has historically been deeply cyclical. The current upcycle has been unusually long, and mean reversion is always a risk.
Fair points all around. Let us do a quick peer comparison. KLA versus the other big names in semiconductor equipment. How does it stack up?
Against Lam Research, which trades at about 26 times earnings. Lam is growing revenue at 22% with an EV/EBITDA around 22 times and operating margins near 30%. Applied Materials trades at about 22 times earnings, but is actually seeing a slight revenue decline of 2% with margins around 28%.
And then ASML, the EUV lithography monopoly.
ASML trades at roughly 35 times earnings with 15.6% revenue growth and operating margins around 35%. Its EV/EBITDA is about 30 times. So KLA is actually the most expensive of the entire group on a PE basis at nearly 50 times.
That is a meaningful premium.
It is, and it is justified by the margin profile. KLA's 42% operating margin and 62% gross margin are the best in class among this group. ASML runs about 35% operating margins, Lam around 30%, Applied Materials around 28%. The market is paying up for profitability and the process control moat.
The bottom line on KLA Corporation. This is a $227 billion company with a genuine monopoly in semiconductor process control, elite profitability, and a management team that just made a bold capital allocation statement with the $7 billion buyback and 21% dividend hike.
The AI tailwind is real, the services business is building a durable recurring revenue base, and the balance sheet is clean. But the valuation demands continued execution.
The single most important number for investors to watch.
The Q3 fiscal 2026 earnings report on April 29th. Specifically, watch the services revenue growth rate. If KLA can demonstrate that the 13 to 15% service CAGR target is tracking, it validates the long-term thesis that this company is becoming less cyclical and more predictable. That is what is worth a premium.
Before we close out, a quote that feels right for a company whose entire business is about catching problems before they become disasters. Albert Einstein once said, "In the middle of difficulty lies opportunity."
And KLA has built a 50-year business around finding those difficulties at the atomic scale. That is what a moat looks like.
That is our deep dive on KLA Corporation, ticker KLAC, episode 106 of Charged Alpha.
The chip inspector that never blinks.
This is Charged Alpha, the S&P 500 stock encyclopedia. Before we go, if you are enjoying Charged Alpha, make sure to subscribe on your favorite podcast platform. We drop a new S&P 500 deep dive every week, and the best way to never miss one is to hit that follow button. Leave us a rating and review if you're finding these episodes useful. It helps other investors discover the show.
You can also find show notes, charts, and the full financial breakdown for every episode on our website. If there is a stock you want us to cover next, drop us a line. We read every suggestion.
And remember, this show is for informational and educational purposes only. Nothing you hear on Charged Alpha is financial advice, a recommendation to buy or sell any security, or an offer to transact. Always do your own research and consult with a qualified financial advisor before making investment decisions.
Past performance does not guarantee future results. All investing involves risk, including the possible loss of principal. The hosts and producers of Charged Alpha may hold positions in the securities discussed.
Thanks for listening. We will see you next time on Charged Alpha.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.